All right, let's dive right in. We're going to pull back the curtain on what really separates the legendary companies from, well, everyone else. We're talking about strategic financial management, and I'll tell you right now, this isn't about boring accounting. This is about the art of winning. So how exactly do the best of the best pull it off?
I mean, really think about it for a second. What makes a company a powerhouse? Not just for a quarter, but for decades. It's definitely not just a cool product or some flashy ads. The real secret weapon, what we're looking at today, is a unified master plan. It's a framework that ensures every single decision, from the top floor of the C-suite all the way down to the front lines, is all pulling in the exact same direction.
And here it is. This is that master plan boiled down to its absolute essence. It's this simple, powerful formula. You take a clear strategy, you add the right financial horsepower, and you have the management team that can actually execute. You get this recipe right, and you've built the foundation for something truly special. This is the bedrock of how great businesses operate.
Okay, so let's give this idea its proper name. What we're really digging into here is strategic financial management. This is the discipline, the actual framework that brings that winning formula to life inside a company. Now here's the absolute key difference, and you've got to get this. Traditional finance and accounting, that's all about looking in the rearview mirror. It's reporting on what's already happened. Strategic financial management, that's about looking out the front windshield. It's all about figuring out where you want to go and then using your resources, your cash, your capital, as the fuel to get you there. It's forward-looking, not backward.
I know. That sounds like a massive job, right? But the good news is we can actually break this entire complex idea down into 4 key pillars. These are the 4 fundamental decisions that every single company on the planet, whether it's a tiny startup or a global giant, absolutely has to nail.
And it flows in a really logical way. First up, financing. Simple question, where do we get the cash? Next, you've got investment decisions. Okay, we have the cash, now where do we put it to work to get the biggest bang for our buck? Then comes dividend decisions. We've made some profit, great, now what? Do we give it back to our shareholders, or do we plow it back into the business to grow even more? And finally, portfolio decisions. This is about looking at all those other pieces together and managing them as one cohesive, powerful machine.
So who's actually making all these huge calls? Well, here's the thing. It's not just one person in a corner office. For a strategy to truly work, it has to cascade down through the entire organization. It operates on different levels all at once. Let's take a look at how that works.
Right at the very top, you've got the corporate level strategy. This is that 30,000-foot view. The board of directors is asking the biggest questions imaginable here. Things like, what industry should we even be competing in? Should we buy that competitor? Should we sell off this entire division? This is all about shaping the entire scope of the company.
Now let's drop down a level to the business strategy. If the corporate level decides what game the company is going to play, the business level decides how to win that specific game. This is where, say, one division of a big company figures out its unique competitive advantage to crush its rivals in the marketplace.
And finally, we zoom all the way in to the functional level. This is where the rubber really meets the road. This is how the big picture strategy gets turned into actual day-to-day actions by every department: marketing, operations, and of course, finance. And let's be clear, the finance team here isn't just counting beans. They are the ones providing the fuel and the financial roadmap to make the entire strategy possible.
And that brings us to a really critical point. The relationship between that big, grand company strategy and its day-to-day financial policies, well, they aren't two separate things. They're locked together in this constant dance, a feedback loop. Just look at this. It's a perfect illustration of that two-way street. On one hand, a big, bold strategy, like deciding to expand into a new country, immediately creates a financial need. You have to have a policy for raising that money, but it absolutely goes the other way too. If your company has a very conservative financial policy, say you refuse to take on debt, well, that can seriously limit your strategic options. That ambitious growth plan might be dead before it even starts. You see, strategy shapes finance, and finance shapes strategy. They're inseparable.
So you've got this multi-level strategy. It's working with a smart financial policy. Where is all this heading? What is the end game? Well, it's not just about getting bigger for the sake of it. The real prize, the holy grail of all this work, is achieving sustainable growth.
So, what does sustainable actually mean? In the world of finance, it's not just a buzzword. It's a specific number, the sustainable growth rate, or SGR. The best way to think about it is as a speed limit.
It's the absolute fastest your company can grow using only its own internal resources, without having to raise more debt or ask investors for a fresh pile of cash. It's the ultimate test of self-sufficient strength.
And here's the formula behind it. Now don't worry, don't let the math freak you out. It's actually incredibly simple. It's made of just two things. First, return on equity, or ROE. That's just a fancy way of saying how good the company is at making a profit with the money its owners invested. The second part is just how much of that profit the company decides to keep and reinvest. So, simply put, your sustainable growth just depends on how profitable you are and how much of that profit you plow right back into the business. That's it.
Now, for this SGR model to work, a company has to follow a few ground rules. Think of it as a disciplined approach. They have to keep their mix of debt and equity stable, they have to keep their dividend policy consistent, and then they try to grow sales as fast as they can within those constraints. It's all about disciplined, controlled growth.
Okay, this all sounds great in a textbook, but does it actually work in the messy real world? Absolutely. Let's take a look at a fantastic case study, the global powerhouse Mitsubishi Corporation. They went through a massive shift to build their entire company around this very idea of sustainable growth.
I mean, this quote from their own strategy document says everything. Just look at the keywords they use: stable earnings, business cycles, managing a portfolio. They are explicitly saying they are not chasing short-term flashy profits. They're building a resilient company designed to grow steadily through good times and bad. That, right there, is the heart and soul of strategic financial management.
And they put their money where their mouth was with their new strategic direction plan. They set a huge, long-term goal to double the business. But how? Not by just doing more of the same. They did it by actively reshaping their portfolio, selling off some parts, investing heavily in others, all while sticking to incredibly strict financial discipline. It's really a masterclass in this entire concept.
And so, after looking at all of this, from the basic formula to the real-world execution, it all boils down to one final, powerful question. And I want you to think about this for any company you know, whether you work there, invest in it, or just buy its products. Is that company truly growing in a sustainable way that creates real, long-term value? Or is it just getting bigger? The difference between those two is everything.